There are moments in the history of global energy markets when a single decision, made by a single man in a single room without a parliamentary vote or shareholder meeting or any of the democratic accountability mechanisms that govern consequential choices in open societies, sends a shockwave through the global economy that is felt in the price of fuel at gas stations in Ohio, in the operating budgets of airlines in Tokyo, in the inflation calculations of central banks in Frankfurt, in the geopolitical calculations of governments from Beijing to Brussels to Washington. Moments when the abstraction of oil market dynamics becomes concrete and immediate in the lives of billions of people who have never heard of an OPEC meeting and could not locate the empty quarter on a map. Mohammed bin Salman just created one of those moments. What MBS has done with Saudi oil strategy in the past several weeks, the specific decisions he has made about production levels, about pricing mechanisms, about the relationship between Saudi Arabia's energy policy and its broader geopolitical ambitions, has shocked Washington in ways that go beyond the routine friction of American-Saudi disagreements about barrel counts and market share. What has shocked Washington is not simply the content of the decisions. It is the demonstration of strategic independence that the decisions represent. It is the evidence that the man who controls the world's largest conventional oil reserves has decided that the era of calibrating Saudi oil strategy around American preferences, the half-century arrangement in which Riyadh consulted Washington before making moves that affected global energy markets, is over. Not modified, not adjusted, over. The implications of that decision for global markets, for the dollar, for American foreign policy leverage, for the inflation environments of every major economy, and for the specific calculations of every actor in the global energy system who has been operating on the assumption that Saudi Arabia's behavior is ultimately constrained by its American relationship. Those implications are what this story is about, and they are more consequential, more far-reaching, and more structurally significant than any of the immediate market reactions are yet capturing. To understand what MBS has done and why it has shocked Washington in the specific way that it has, you have to understand the history that it is departing from, the specific arrangement between Riyadh and Washington that has governed Saudi oil strategy for 50 years, and that is now being deliberately and comprehensively dismantled. The petrodollar arrangement that was constructed in 1974 in the aftermath of the first oil crisis was not simply a financial agreement. It was the foundational architecture of a strategic relationship whose terms were simple and whose implications were enormous. Saudi Arabia would price its oil in dollars, would invest its resulting surpluses in American financial markets, and would use its OPEC leadership to maintain a global oil market that served American economic and strategic interests. In exchange, the United States would provide Saudi Arabia with security guarantees, with advanced weapon systems, with the specific protection of American military power that the kingdom's leadership understood was essential to its survival in a neighborhood containing Iran, Iraq, and the various non-state threats that have periodically challenged the Saudi state's stability. For 50 years, this arrangement held. It held through multiple oil crises, through regional wars, through the specific tensions generated by 9/11, and the discovery that 15 of the 19 hijackers carried Saudi passports, through the Arab Spring, through the murder of Jamal Khashoggi and the international outrage that followed, through the Biden administration's very public attempts to pressure Saudi Arabia on human rights and on oil production levels, and through the sustained American development of shale oil that progressively reduced American energy dependence on Gulf imports, and therefore progressively reduced the strategic value of the security guarantee from the Saudi perspective. Through all of those stresses, the arrangement held, because both sides continued to calculate that the benefits of the relationship outweighed the costs of the specific frictions it generated at various points. What has changed, what MBS has identified as the specific shift in circumstances that makes departing from the arrangement not just possible, but strategically optimal from Saudi Arabia's perspective, is a convergence of three developments that have occurred simultaneously and that together have altered the fundamental calculus of the relationship in ways that 50 years of institutional inertia cannot sustain. The first development is the completion of Saudi Arabia's alternative relationship infrastructure. Building a credible alternative to American partnership as the organizing principle of Saudi foreign policy is not something that can be done quickly or in a single dramatic gesture. It requires patient cultivation of alternative relationships with China, with Russia, with India, with the emerging economies of the global south, to the point where those alternatives provide genuine strategic depth rather than merely rhetorical cover for positions that are ultimately dependent on American goodwill. MBS has been building that infrastructure for years. The Chinese relationship, expressed in the enormous volume of Saudi oil that flows to Chinese refineries, in the Saudi participation in Chinese-led multilateral frameworks, in the specific financial and technological relationships that have been developed between Saudi and Chinese institutions, has reached a depth that provides genuine strategic alternatives to American dependency. The Russian relationship, complicated by the Ukraine conflict, but maintained through the OPEC Plus framework that has been one of the most consequential energy market institutions of the past decade, provides a coordination mechanism for oil market management that does not depend on American approval. The Indian relationship, cultivated through the enormous and growing volume of Indian economic engagement with the kingdom, adds a third major power partner whose strategic interests sometimes align with Saudi interests against American preferences. The second development is the specific weakening of the American security guarantee that has been the Saudi side's primary reason for accepting the constraints that the petrodollar arrangement imposed. American strategic attention has diversified. The pivot to Asia, the sustained engagement with European security generated by the Ukraine conflict, the domestic political pressures that constrain American foreign policy commitment in every theater, in ways that have made the Gulf Security Guarantee feel less absolute, less unconditional, and less strategically reliable than it was during the period when the Middle East was the organizing priority of American foreign policy. Saudi Arabia's development of alternative security relationships, the Pakistani military framework, the deepened relationships with Chinese security institutions, the investment in indigenous defense capability, reflects MBS's assessment that the American security umbrella cannot be the sole basis of Saudi strategic security in an environment where American strategic reliability is less certain than it once was. The third development is Vision 2030 and the specific strategic logic it has introduced into Saudi energy policy decisions. Vision 2030 is not simply an economic development plan. It is a strategic timeline. It is MBS's understanding that Saudi Arabia has a specific window. The period before global energy transition reduces the economic and strategic leverage that oil wealth provides, in which to use the resource to transform the kingdom's economic and institutional foundations. Every decision about oil production and pricing is therefore a decision about how to optimize the remaining value of the resource for the kingdom's transformation objectives, rather than a decision about how to maintain an international arrangement that served Saudi interests in a previous strategic environment. With these three developments converging, MBS made his move. And the specific content of the move, the oil strategy that has shocked Washington, involves several interconnected decisions that are being implemented simultaneously and whose combined effect is greater than the sum of their individual parts. The first element is the deliberate use of production increases to drive oil prices below the threshold that makes American shale production economically viable at its current scale. This is not a new instrument. Saudi Arabia used it in 2014 and again in 2020 to pressure American shale producers. But the current application is different in a crucial respect. Previous applications were primarily economic in their objective. They were about market share, about discipline within OPEC, about the specific commercial calculation of whether lower prices with higher volumes serve Saudi revenue interests better than higher prices with lower volumes. The current application has a geopolitical objective that is primary. It is specifically designed to pressure the American shale industry at a moment when American energy independence, the specific strategic asset that American energy policy has been building for a decade, is most exposed to price pressure, and when the political consequences of that pressure in American domestic politics are most useful to MBS's broader strategic objectives. American shale production is not uniformly profitable at all price levels. Different shale formations have different break-even costs. The price per barrel below which production from a given well or formation becomes economically rational to curtail. The break-even costs for the most productive American shale formations, the Permian Basin in particular, are low enough that Saudi price pressure cannot eliminate American shale production entirely without driving prices to levels that hurt Saudi Arabia's own revenue position. But there are significant volumes of marginal American shale production whose break-even costs are higher, production from older wells, from less productive formations, from operators with higher debt service costs, that are vulnerable to sustained price pressure at the levels that Saudi production increases can achieve. By targeting this marginal production, MBS is not trying to destroy American shale. He is trying to demonstrate to Washington that Saudi Arabia has the ability to impose economic pain on American energy producers when it chooses to do so, that this ability is now being exercised in service of Saudi strategic objectives rather than suppressed in deference to American preferences, and that the era of American shale insulating Washington from the consequences of deteriorating relations with Riyadh is over. The message is precise, and it is being received in exactly the terms in which it was sent. Washington's reaction to the production increase, the specific combination of public statements expressing concern about market stability and private diplomatic engagement seeking to understand MBS's ultimate objectives, reflects the recognition that what is happening is not simply an OPEC production decision, but a geopolitical communication of the first order. The second element of MBS's new oil strategy is the acceleration of non-dollar oil pricing mechanisms, the specific push toward pricing Saudi oil sales to major customers in currencies other than the dollar or in commodity settlement frameworks that bypass dollar clearing. That was discussed in the context of the Saudi-Iran Gold for Oil Pact, but that extends beyond that specific bilateral arrangement into the broader architecture of Saudi oil market engagement. Saudi Arabia's oil sales to China, which account for a large and growing share of Saudi total production, have been the primary arena for this shift. Yuan-denominated pricing of some Saudi oil sales to Chinese customers is now operational, not experimental. The volume of Saudi oil flowing through non-dollar settlement mechanisms is growing quarterly, and the institutional infrastructure, the pricing benchmarks, the settlement protocols, the custody arrangements that makes non-dollar Saudi oil pricing operationally sustainable is being developed and refined with the active support of both Saudi and Chinese financial institutions. Washington's concern about this element of MBS's strategy is not primarily about the current volumes. The current volume of non-dollar Saudi oil trade is not large enough to destabilize the petrodollar system on its own. Washington's concern is about the trajectory, about the demonstration that non-dollar Saudi oil pricing is operationally viable, that it can be scaled, and that Saudi Arabia is actively choosing to scale it as a matter of strategic policy rather than merely permitting it as an experimental accommodation to specific customer preferences. Trajectory is everything in the structural analysis of monetary systems. The dollar's reserve status is sustained by network effects, by the self-reinforcing dynamic in which everyone uses dollars for commodity pricing, because everyone uses dollars for commodity pricing. Network effects are robust until they are not, until the alternatives achieve sufficient critical mass that the network effect begins to work in the alternative's favor rather than the incumbents. MBS's non-dollar pricing push is not yet at the threshold where it threatens dollar reserve status in an immediate crisis-generating sense, but it is deliberately and systematically moving toward that threshold in ways that every serious analyst of the dollar's long-term position is tracking with the urgency that structural rather than cyclical threats generate. The third element of MBS's oil strategy is the specific use of Saudi production decisions to reshape the OPEC Plus coalition in ways that entrench Saudi Arabia's leadership while reducing the influence of the members, including the UAE, whose interests have been diverging from Saudi preferences. The dynamics of the Abu Dhabi rivalry have found their expression in the OPEC Plus context, as well as in the bilateral financial competition that was discussed previously. Saudi Arabia's production decisions within the OPEC Plus framework, the timing of increases and decreases, the specific allocation of production adjustments across members, the management of the compliance monitoring mechanisms that determine how production quotas are enforced, are being calibrated to serve Saudi strategic interests in ways that increasingly override the coalition management considerations that previous Saudi OPEC leadership prioritized. This reshaping of OPEC Plus around Saudi strategic primacy is itself a form of geopolitical signaling, a demonstration to every member of the coalition and to every outside actor that engages with OPEC Plus as an institution, that the era of multilateral oil market management in which Saudi Arabia was one voice among several has been replaced by an era of Saudi direction in which other members operate within a framework whose parameters are set in Riyadh. The fourth element, and the one that has generated the most acute concern in Washington, is the explicit linkage that MBS has drawn between Saudi oil strategy and specific geopolitical outcomes that he is seeking from the United States. The conditionality is real, and it is being communicated through channels that bypass the diplomatic niceties of formal negotiation. Saudi production decisions are being calibrated to create economic pressure that Washington finds painful, and the relief from that pressure is being linked through the informal communication channels of Gulf diplomacy to specific American policy adjustments that MBS is seeking. The specific adjustments he is seeking reflect the full range of Saudi strategic interests in the current environment. American positions on Iran, specifically, the degree to which Washington supports or tolerates the Iranian nuclear program's continued development, and the degree to which American military posture in the Gulf credibly addresses Iranian threats to Saudi interests. American positions on Palestinian statehood, the specific conditions under which Washington would support a Saudi-Israeli normalization process that includes meaningful progress on the Palestinian question that MBS has identified as a political prerequisite for any normalization he can sustain domestically. American positions on Saudi Arabia's internal governance, the degree to which Washington continues to make the bilateral relationship contingent on human rights progress and on accountability for the Khashoggi murder in ways that MBS regards as unacceptable interference in Saudi internal affairs. These are not small asks. They are demands for substantive American policy changes in domains where American positions are shaped by domestic political pressures, by alliance relationships, and by the institutional commitments of the American foreign policy establishment in ways that make accommodation difficult regardless of the economic pressure MBS is applying. Washington cannot simply announce that it no longer cares about Saudi human rights, or that it is prepared to give Iran a nuclear program, or that Palestinian statehood is no longer a policy interest because the Saudi oil strategy demands it. But Washington also cannot simply ignore the economic pressure that the oil strategy is generating. The domestic political consequences of oil prices above certain thresholds, the gas station price boards that become political referendums on presidential competence in ways that American politics has demonstrated repeatedly, create real constraints on how long any American administration can maintain a posture of public indifference to Saudi production decisions that are driving prices higher. This is the trap that MBS has constructed. And Washington is inside it without a clean exit. The global market implications of MBS's oil strategy extend far beyond the American-Saudi bilateral relationship and deserve examination in their full international dimension. For Europe, which has been managing energy security concerns that became acute after the Russian invasion of Ukraine, disrupted gas supplies, and forced a massive and expensive restructuring of European energy import patterns, Saudi production decisions operate within an energy security environment whose political sensitivity is extreme. European governments have been rebuilding their energy import infrastructure around assumptions about Gulf supply reliability that MBS's new strategic independence is now complicating. A Saudi Arabia that prices its oil on geopolitical considerations rather than market efficiency creates planning uncertainty for European energy importers. That has costs which ultimately fall on European households and European industries already dealing with energy costs significantly higher than their pre-2022 levels. For China, the Saudi oil strategy is largely positive. A Saudi Arabia that is moving toward non-dollar pricing, that is deepening its strategic relationship with Beijing, and that is using oil market management as an instrument of pressure against Washington, is a Saudi Arabia whose behavior aligns with Chinese strategic interests in most relevant dimensions. But China also has an interest in oil market stability that purely political oil pricing can undermine. Chinese industrial planning depends on energy cost predictability, and a Saudi Arabia using production decisions as a geopolitical instrument introduces volatility that has its own costs for Chinese economic management. For the developing world, the nations of Africa, South Asia, and Latin America, whose energy import budgets are most sensitive to oil price levels, Saudi oil strategy decisions are matters of immediate economic consequence that affect food security, industrial capacity, and the fiscal positions of governments already operating under severe resource constraints. High oil prices generated by Saudi production restraint impose costs on these nations that dwarf the costs felt by wealthier importers and the specific form of strategic independence that MBS is exercising. Calibrating production to serve Saudi geopolitical objectives rather than market efficiency imposes those costs without any accountability mechanism that affected developing nations can access. The International Energy Agency, OPEC's institutional counterpart in the consumer country world, has been watching MBS's strategic shift with the specific concern of an institution whose entire operational mandate, ensuring adequate global oil supply at prices consistent with economic stability, is being complicated by a Saudi Arabia that is using supply management as a geopolitical instrument. Now let's examine what comes next. What the realistic trajectory of MBS's oil strategy looks like from this point, and what its implications are for the specific actors whose behavior will determine how the situation evolves. The most important near-term variable is American domestic politics. Specifically, the degree to which the economic pressure that Saudi oil strategy is generating translates into political pressure on the American administration that is sufficient to produce the policy adjustments MBS is seeking. This is a calculation that MBS is making with the specific information that his intelligence apparatus and his diplomatic network can provide about the American political environment, information that is necessarily incomplete and that carries the specific distortions of an authoritarian leader's intelligence system, whose incentive structure does not always reward accurate assessment over pleasing assessment. If MBS's political read on Washington is correct, if the economic pressure generates sufficient domestic political pain to produce meaningful accommodation on the specific policy questions he has raised, then the oil strategy will have achieved its objectives and will have established a new precedent for the use of energy leverage in the Saudi-American relationship that will shape that relationship for years. If his read is incorrect, if Washington absorbs the economic pressure without policy accommodation, finding domestic political ways to manage the pain that MBS did not adequately model, then the strategy risks producing a more adversarial American-Saudi relationship without the compensating policy gains that justified the adversarial posture. The second critical variable is the response of other major oil producers to Saudi strategy. OPEC plus cohesion is not guaranteed. Russia has its own interests in oil price levels that do not always align with Saudi interests. The UAE, whose divergence from Saudi positions has been a recurring theme, has shown willingness in the past to deviate from Saudi production targets when its own interests dictate. A Saudi strategy that strains OPEC plus cohesion while simultaneously antagonizing Washington could produce an outcome: loss of both the coalition discipline that amplifies Saudi market power and the American relationship that provides strategic insurance that is worse for Saudi interests than either the status quo or the successful execution of the new strategy. The third variable is the response of global energy markets to the specific signal that MBS's strategic independence sends about the reliability of Saudi oil supply as a foundation for energy security planning. If major oil importers, the United States, Europe, China, India, accelerate their energy transition investments in response to the demonstration that Saudi supply reliability cannot be assumed, the timeline of the global energy transition could be pulled forward in ways that reduce the strategic window within which Saudi Arabia can use its oil leverage to fund Vision 2030. This is the ultimate irony embedded in MBS's strategy. By using oil as a geopolitical weapon more aggressively than his predecessors did, he may be accelerating the very process, the transition away from fossil fuel dependence, that will eventually render that weapon obsolete. Every time oil importing nations experience the pain of supply disruptions or strategic price manipulation, they add political urgency to the domestic case for reducing oil import dependence through efficiency, improvements, renewable energy deployment, and electrification of transportation. The success of MBS's short-term leverage strategy may be contributing to the erosion of the long-term asset base that the strategy depends on. MBS, who understands this dynamic intellectually through the Vision 2030 framework that is built on the recognition that the oil era is finite, is presumably incorporating this irony into his calculations. The question is whether the short-term strategic gains he is pursuing through his new oil strategy are large enough and durable enough to justify the acceleration of the transition timeline that the strategy's aggressive deployment may be contributing to. Washington does not have a clean answer to what MBS has done. The toolkit of American responses, diplomatic pressure, security guarantee modification, arms sales leverage, multilateral coalition building against Saudi positions all carry costs and limitations that make none of them fully adequate to the specific challenge that MBS's strategic independence represents. And the absence of a clean American answer is itself part of what MBS has achieved, a demonstration that the relationship's terms have changed in ways that Washington must now adapt to rather than simply resist. The global markets that are absorbing the shock of MBS's new oil strategy are recalibrating in real time. The recalibration is visible in oil futures curves, in currency movements, in the investment flows of energy companies reassessing their development portfolios, and in the strategic planning documents of governments across the importing world who are updating their energy security assumptions in light of what Saudi Arabia's strategic evolution means for the reliability of Gulf supply. Those recalibrations are the market's way of pricing in a new reality. A reality in which the world's most consequential oil producer has decided to use its position as an instrument of its own strategic ambitions, rather than as a service to the global economic system. A reality in which the petrodollar arrangement that organized the global energy economy for 50 years is being deliberately and systematically unwound by the man who has the most power to unwind it. And a reality in which Washington, the capital that has been the organizing center of the global energy order since 1974, is discovering that the leverage it assumed was permanent was actually conditional on a relationship whose terms have just been unilaterally revised. MBS made his move. Washington is shocked, and the global markets are only beginning to price what it means.